I, 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 He got fired from Kane, now we ain't got no shame. So we started a pod, Chuck Yates needs a job.
Hey everybody, welcome to Chuck Yates Needs a Job, the podcast. In the never-ending quest to talk about things I know nothing about, we have Exhibit A coming up, but really lucky that Bryan Sansbury from Aegis Energy is my guest today. Welcome in, Bryan.
No, thanks. Thanks for having me.
So you and I were kind of texting, emailing back and forth because we never met. And I think your opening remark was, yes, Yates, you never hired me for any portfolio companies at Kane. Is that really true?
That is true. We may have met once when you came into a pitch we were doing at Kane. And I will, because I love your podcast and I always watch, and I would just remind your viewers that you didn't hire us and you were subsequently fired. So I don't know if that's directly related, but that's what I know.
So I was talking to a CFO of one of the oil and gas companies today, and he said, you know what? I'm glad you got fired, Yates, because prices have only gone up since they kicked you out. So I've got that going for me too. So there we go. So you have kind of this wild story on how you started Aegis, all that. Aegis, sorry. I'm going to say Aegis 5 times. I apologize. Walk me through that real quick, because you weren't a lifelong energy guy.
No. In fact, I spent 22 years outside of energy and taken what was an advisory business into a really tech-driven business, which we can certainly talk about. But had a good friend who was in the business, worked for one of our competitors. He was struggling a little bit on a little crossways with some future decision making and what they wanted to do with their company. And, you know, I knew I didn't want to do what I was doing for a long time. And, and so I said, why don't you start your own? And, there were a lot of concerns, capital, leadership, all sorts of things. I said, I'll back you, you start it. And someday I'll be able to walk away from what I'm doing now and I'll join you, which I don't think he ever thought would happen. But, Aegis was formed over several bottles of wine, at a beach one night while I was, on my way to transferring up to Chicago.
Most good stories start that way. All buddy movies start with too much wine. So literally y'all started, when was that?
2013. So I think September 2013 was our formation date. I joined full-time in October of 2017. So you just kind of grew up as an advisory business early on while I was in my prior career, and had a chance to transition out and join Aegis full time in 17 and done some fun things with it since then.
Cool. So what do you guys do? What and maybe when you talk about that kind of evolution over time of what you do?
Sure. So we'll start with today.
Yeah.
Software, advisory, great people, helping people navigate the hedging and carbon offset markets. That's the simplest stuff across, oil and gas, manufacturing, transportation, et cetera. So the business has evolved a lot. When we started the business, it was very much, founded on this belief that hedging transactions, complex derivatives that people use to protect their prices, especially in oil and gas. We were in Houston. It was the logical place to start, that people needed help facing off with the likes of Goldman Sachs and JP Morgan and Citi and the big players on what's the right structure, what's the right tenor, what's a fair price, et cetera. So it was a pure advisory business when we started.
Yeah, because what always happened, it seems like you're making an acquisition, right? You're an E&P company and you're closing on, let's say July 15th. And all the week up to it, you generally had to, at least back in the day, do your hedging through the bank that has your borrowing base, has your RBL. And they always quoted you. And then literally on the day of closing, the market moved $1 a barrel or something because they had you over the barrel. There were such nice guys at J. Aaron. Yeah, exactly.
Well, look, that's kind of part of it. And we thought that, people that are, that are finding oil and gas and exploring, and now it's transitioned to people who are making beverages or, growing ags or moving product. They need to focus on doing that. They don't need to be experts in the derivatives market. And so, that has always been at the core of who we are, is that we can help them be, better, better at the table when they're facing off and hedging their commercial risk.
And so I mean, producers, kind of when I got into the business, you actually wanted to be unhedged, because that's why investors were investing. They wanted exposure to the commodity markets. And then you would have downturns in which everybody would get fired because you went bankrupt. And then CEOs started saying, we might want to hedge. That might be better. And so you grew up with, in terms of oil and gas companies wanting to hedge, lock in prices. There always had to be somebody on the other side of those trades. What you just said that I think is interesting, that I don't know anything about, and I'd love to hear more about, is who's on the other side of the trades, and are they really locking in costs? Because it would make a lot of sense. I mean, if I'm an airline, theoretically, I should be locking in costs just for predictability. But
yeah, so everything that we do is bilateral in nature. Direct contract between a producer or consumer. So we'll come back to that, and a financial institution. That is how these markets are made. And so we don't have an oil and gas company facing off with an airline per se. Both of them would be facing off with a financial institution, who's then able to lay that market out, or lay that risk off in the market, or hold it if they'd like. But you're exactly right. If I'm a upstream.
So real quick, I'm gonna cut you off. I'm sorry. The financial institutions that do that, you have the big money center banks that all seem to have arms. Are there other folks doing that too?
There are. You'll have a number of folks who are doing both secured and unsecured, folks like Cargill or Nextera, or Coke was in the business for a long time. They're starting to get into KOCH, Coke. So there are a number of different players. Shell, BP have desks that do different trading as well. So you're right. Money center banks and a number of others who are willing to take positions and sometimes do it in an unsecured way.
Gotcha. So okay, that's interesting. So basically, they're sitting in the middle, and it makes sense because you need a balance sheet if you're going to take the trade. And so the producer side of it makes sense to me. It's hey, oil's at 75, great. I want to lock that in. Do you work with any of the consumers? Oh, cool. Tell me something about that, because that's something I don't know anything about.
Sure. So we've got beverage manufacturers that have massive aluminum exposures. If you think about, purchasing billions of aluminum cans a year. So we made an acquisition of a company called Nexus Commodities about a year and a half ago that got us into that space, so that now people can lever. When we say producers or consumers, when you're a consumer, your price risk is the exact opposite way if you're a producer. And so you can hedge those risks also. When you're in manufacturing, you can see, I take a big beverage manufacturer and just play that through. They also have diesel exposures because they're shipping their products different places. They have bunker fuel exposures as they put that product on ships. They have FX exposures because they're selling in multiple countries. In many cases, they have interest rate exposures because they've got debt on their facilities. They've got power exposures and exposure to natural gas because they're consumers of all of those different commodities.
And if you're a beverage manufacturer, I would think your revenue top line dollar per bottle is pretty sticky. I mean, right? I mean, you have inflation and you adjust prices and all, but for the most part, Coke wants to sell the bottle the same price every year. That's right.
And your consumer on the end of the product expects to pay a certain price when they walk into a convenience store or a grocery store. You have seen those prices move substantially here lately, like everything. But you're right. If you're a manufacturer, you want to keep your prices consistent.
Yeah. The thing I saw it move this weekend that struck me that I hadn't noticed before is when you go buy ice, like ready-made ice from the grocery store, they're no longer 10-pound bags. They're 7. And they still cost $2.
Really?
Yeah. It's a 7-pound bag now. When you go to the grocery store and just check it out, because that's the other way you handle inflation, right? You just give them less. It's interesting. So So what would a typical consumer, or I guess, yes, consumer look like? And just totally make this up. And again, it's because I know nothing. And this is interesting to me is, are they hedging 3 years out, 5 years out, 6 months out? And I know everybody's going to be different, but give me an example of.
Yeah. So you're going to see oil and gas producers right now, as you know, getting out, 3 years in most cases. We just did someone hedged out all their production for 5 years, 100%. Did a recap, and that's a great way to lock in your cash flows. Most markets won't allow you to go out that far. When you look in the metals markets, you're looking at a year or 2 years, generally speaking, is about as far out as you can get. And there's a lot of backwardation in those markets. Lumber's even shorter than that. So you see home builders, hedging, lumber costs. Jet fuel, you can get out a little further, a couple of years. So we're seeing airlines get a lot more interested in hedging again. Those programs that went, that people got so scared of for a while. Right. We're seeing those come back, and you could hedge jet fuel. You could buy calls on jet fuel for 90 cents in the middle of the pandemic, and jet fuel is a lot more expensive than 90 cents right now. So that was a really good hedge to make.
And they also had every plane sitting on the ground. Right. I mean,
that's right.
That was, yeah. But so is this a true statistic? I'm sorry, I'm jumping around, but the problem with a ADD podcast host, the one issue that the airlines have is, it's my understanding that, at least historically, I don't know if this is true post-pandemic, is some ridiculous percent of the ticket sales on each individual flight, 80%, I'll kind of make that up, happen in 2 weeks before the flight.
Which is good.
Well, but if that's your revenue, and you're talking about locking in the price of fuel, I now understand why it's kind of tough for them.
Right. Well, there's no doubt about that. Yeah. But if you're setting a schedule out, because people are purchasing tickets on flights 6 months, a year from now. I saw people talking about buying flights that are really expensive out a year from now. If you can start to lock in your cost, and you have a lot more control of, every move you make from a revenue perspective can just be a lot smarter. If you understand what your underlying.
And are airlines really that sophisticated? I would think they are.
They're pretty darn sophisticated.
Hey, we've got X number of miles bought a year out. Let's go lock in the fuel costs today.
Absolutely.
And we've guaranteed our profit.
Absolutely.
Oh, that's interesting. Because I think it was Southwest Airlines at one point hedged out 5 years when oil prices were really low, and the great profit run they had, and they were writing articles about how well they were doing. Literally was just the hedge.
Yeah. Well, we were actually talking about that this morning in the office, that I wish people didn't even talk about it. Because if you remember the language that was being used back then, and we'll compare it to what's being happening today, they were talking about these huge gains they were getting on their hedge book, right? And you hear the same sort of language being used with hedging today on these big losses that people have on their hedge book if you're an upstream oil and gas producer, right? And that is a mark-to-market loss, and we can certainly see. But as my good friend Gary Tanner at Quantum always says, that the country club is filled with people who sold too early.
Yeah.
And so if you're an oil and gas producer, and let's just use it in what people think about it. If your cost of Apple stock is $2 a share, and you sell it for $5 a share, and it proceeds to go to $9 a share, how much did you lose?
Yeah.
I mean, you didn't lose anything. Right. You made money. You decided to sell at $5. Right. You can't worry about what the stock did afterwards. And you have to think about hedge programs the same way. If you sold your gas at $5 and your lifting costs are $2, you're making a lot of money. Could you have made $9? Sure. But you protected yourself, and had certainty. And I'd say the same thing about Southwest Airlines. They had, quote, gains on their hedge book, but they paid a higher cost in the field. What they did is they locked in their price. So they had surety.
Yeah.
And that's what hedging needs to be about, is about surety, not about trying to drive alpha in an investment portfolio.
Yeah, no, I think certainty, and you're right. I mean, the beta just so dominates our industry, really on both sides, because, the great Amazon run of all time. Well, we had historically record low oil prices, i.e. low gasoline. That's why all those vans got to run around. There's definitely a day of reckoning coming to those guys.
Well, I thought y'all did a great job on Zero talking about Amazon's carbon footprint for exactly those reasons. And that is, you're right. Those were built on the back of, low, crude prices. And there's no other way to say it.
Yeah, I tweeted out one day that they need to pay for the plugging and abandonment liabilities of all the old wells. So we've kind of got this active market on what I'll call the consumer side of energy. How has that market changed over time? And I'm thinking, but you correct me where I'm wrong. One, it's gotten a lot more sophisticated, and then two, there's probably a lot more in the way of software and technology to help predict and manage that? Or is it still all kind of spreadsheets?
Well, it depends on who you ask.
Yeah.
But you asked about the evolution of our firm. So I joined in 2017. I had a lot of pattern recognition on, hey, there's an advisory business. We happened to be focused on HR. I date myself a bit. Go back when I started in 1995, 401k statements, you may remember this. 401k statements came quarterly. You could change your election quarterly. You enrolled in benefits on a piece of paper.
Right.
Like this plan, and pensions, which aren't really around anymore, but pensions, your ability to figure out what you had was basically zero. And so there was this shift on bringing all that online. So now that's ubiquitous. Everybody knows that to be be online and things you can do. So we started looking at Aegis in late 17 and saying, well, this is an interesting advisory business. I think there's a lot of application for technology. Started out simple. What do people need to report to the board on how much is hedged and at what weighted average price? And we kind of started really slowly. And it ultimately we ultimately built out our technology to do things like ingest confirmations, digitally read them, match them to a trade, and allow you to DocuSign through them. Same thing with a settlement that came in from a hedge. And so every year it's just gotten more and more advanced. More recently, we've been applying analytics. So you were in the industry a long time. People used to say, oh, it should be 75% hedged in the front and 50% next year and 25%. Well, that's silly. That doesn't tell you anything other than maybe the bank had that written into the RBL. But there's a more sophisticated way to think about, what am I trying to solve for? Am I solving for a cost per or a revenue per unit, a top line revenue, EBITDA, et cetera? So we're now applying analytics to allow people to model the impact of hedges. And then most importantly, just the modernization of how these transactions get done. I stepped into this business and, most people were doing it over the phone. Literally pick up the phone, call 5 banks, get bids or offers, try to decide. By the time you got the 5th bid, the first bid was no good anymore.
Market moved on us.
Right, that's what we were talking before. And so, and the more advanced folks are using Ice Chat, which we're users of Ice Chat ourselves, but it's effectively like.
And
trading.
what's Ice?
Well, Ice is a broad market, does lots of different things. They have a product called Chat that's effectively like you.
So that's the Intercontinental Exchange.
Yeah.
Gotcha. So that is that a competitor to the NYMEX?
Yes, correct.
Yeah, okay.
They would all have different markets for trading, settling different securities and derivatives. So Ice Chat is effectively like you and I negotiating this significant bilateral contract over WhatsApp or text message, which we thought was odd, someone that was new to the industry. And so we started building out some software to be able to, help facilitate those transactions. Hey, can we push information out to multiple banks simultaneously, collect bids and offers on a single screen, have someone work in order, close out that transaction, pass it, do reporting.
Bring us to like circa 97
Correct.
in the world.
Every other market on the planet works that way. And it was hard to figure out why this bilateral market didn't. And I think where we ultimately landed was the banks didn't really have an incentive. Goldman building a platform for JP Morgan to trade on wasn't really going to happen. And no individual company could build it themselves, right, in a way that banks would facilitate it. So by virtue of, it's probably we're saying we have over 25% of U.S. oil and gas volume flowing through our platform every day on the energy side. And so, we were large enough where we could afford to make that investment to build that technology out. Led us into a whole different discussion, but that sort of full picture of reporting to, analytics to executing trades on a platform has been a really fundamental shift since, even the late, call it 2018.
So was it just the oligopoly didn't want the transparency because they were making enough money, or was it more kind of just stuck in their ways, or all of the above?
I don't know is the short answer. But I just don't think that the market had a logical person to build it. For 40 different banks and unsecured, folks to get together and come up with a platform, that's a long putt. And so I just don't think there was the incentive for anybody to get together and get a platform that would make sense. And
So back before I joined Kane Anderson, I was with Stephens, Little Rock, Arkansas investment bank, and I was there 94 to 2001, and you saw the rise of the internet, and you also had the rise of Enron during that. And Enron at some point came up with something, Enron Online, and that was going to be, fully transparent. You're trading with Enron. You no longer have to call, get quotes from us. You can get quotes and everything. And what was interesting about that is Enron was big enough and powerful enough at that point that people were really scared. Do we want to trade straight with them? We're giving them our information. And so one of the ideas we came up with at Stephens was we were going to, and I forget what we were going to call it, but it was basically, it was going to be some anonymous site that would trade with Enron Online. So we'd literally just sit in the middle between people that wanted to trade with Enron Online but needed to come. So we put it together. The Stephens family was willing to back it because it was going to take some balance sheet type issues to do. I want to say we had 4 or 5 different meetings with Enron, including one that I think Skilling said hi at. I don't, and all that. For whatever reason, we didn't get it done, and thank goodness, because we would have been swept up in the bankruptcy. But I just kind of lay out that story because I think a lot of energy trading historically has always had the paranoia of wanting to retain the information, wanting to own it. And so that was probably legacy. So the software kind of stuff that you guys set up, is that a product you sell, or is that just clients of the firm use it? How does that work?
So it's evolved a bit at this point. So it's part of our offering. So our customers would, our traders, or on behalf of our customers, will use the software. We also have customers who only use us for technology we don't do trading for. They'll be able to, to do that trading as well. Now, the shift to swap execution facility, which I'm sure we'll talk about here in a second, actually opens it up where it's going to be available to all folks like us. So other hedge advisors, including our competitors. And there's a bit of a long story on how we got there, but it'll actually be opened up to any market participant, including individual consumers, producers, other hedge advisors like Aegis, even introducing brokers, et cetera. So it'll be open access to the broader community.
Cool. Okay, so walk me through creating the software and giving it to competitors.
That wasn't necessarily the design, but what we did, when we created the software, we sat down with our counsel, regulatory counsel, and said, hey, we just want to make sure that we're doing this right. We don't want to become a FCM or DCM or all these, any sort of exchange was kind of the way I would say it. And we got a clean bill of health in the review and reading the regs. And we just said, we should just talk to the CFTC and just make sure that we've got this right. Legal opinion's one thing.
What is CFTC? It's Commodity
Future Trading Commission.
Futures
Trading Commission.
Futures. Okay.
So they oversee all of the derivative markets. They played a huge role, as you can imagine, in Dodd-Frank, and what that they were really tasked with enforcement and rollout of all the rules around Dodd-Frank, which was meant to bring some additional transparency into the derivatives markets.
Yeah, basically for all the kids in the audience, we almost melted down. What was the name of the hedge fund that oh gosh, one of the ones that brought all the Dodd-Frank stuff around. There was a hedge fund out there that was the definition of systematic risk, and almost went down. And so Dodd-Frank, at least as I understand it, was basically about, let's try to force as many of these trades that go on privately public somehow. Let's get them clearing through exchanges, et cetera.
Yeah, credit default swaps and a bunch of those things were at the core of that. And you're right. But and so Dodd-Frank came along and said, we just know there's these opaque derivative markets. Let's see if we can't get a little more, a little more visibility to them fundamentally. Right. And so, so CFTC does that. They also work with the National Futures Association, which is a bit of their oversight, arm. And we had a conversation with them, and it opened up a really interesting dialogue and them understanding what folks like us, hedge advisors, broadly termed, what we did, and how we function in the market. And, the question was simple. Have we done anything that requires additional registration? We've talked with our counsel. They say no. We'd like your opinion. And after a couple of months, they came back and said, actually, yes, you've got to register as a swap execution facility, which is there's 10 things we could have heard. That probably was the worst outcome. And we really tried to understand why that was.
Hold on, Bryan. I'm going to be a bit of a prick here, but when you go ask a barber if you need a haircut, they always say yes. I'm just saying, but go ahead.
Fair. But we wanted to be clear. We didn't want to be out there with something that could cause us some problems. And they told us it wasn't at all about the technology that we talked about. They told us it was about our business model. And this was very confusing for us and for the entire industry. They said multiple to multiple trading facilities must register as SEFs. That's a lot of words. And we always said, well, we're not multiple to multiple because everything we do is bilateral. One producer facing off with multiple banks, right? That's a single to multiple. And they said, well, you do it for more than one customer, so therefore you are multiple to multiple. Okay, which we didn't understand that. Okay, but they're the boss. But we said, okay, so fine, we just won't use our technology because if we're not a trading facility, we don't need to worry about it. They said, no, trading facility is defined as any form of interstate commerce. Again, a lot of words, but that goes on to say, including phones, chats, other electronic communications, which meant if you do this in this way, have more than one customer facing off with multiple banks, and you use a phone, chat, or other communication, that was the definition of what we did as a core business, then you have to register as a SEF. And so
what does SEF stand for?
Swap execution facility.
Yeah, got it.
Yeah, that's the term for the regulated entity. And so we thought, okay, we need to fill out an application. And I always tell people I literally went to a Starbucks one day in Denver, said, I'll just fill out the application while I'm sitting here. And as I opened up, I said, this is going to be a little more complicated than we thought. And, a year later and 2,600 pages, we had our application in. And rightly so. It's incredibly complex. Are you complying with cybersecurity policies and open access requirements and all the things that are in the regs? But one of those things, kind of wrapping back to the original question, is it's got to be open access. So it's not just for you. It has to be for anyone who wants to become a market participant. And so that opened it up to say, other hedge advisors, other introducing brokers, individual participants who want to participate on it can enter. And so, that again, it wasn't by our design to start that way, but we actually think that's going to be really good for the industry over time if we drive some standards and have a place where there is some additional oversight and tracking and auditing of these transactions.
Yeah, interesting. And just as a side note, I am actually a commodity pool advisor or operator, CPO. So I had to take the test, and I've chatted with the NFA in Chicago multiple times.
Those tests are no joke.
Yeah, no, it was kind of hard. And I thought I'm a pretty sharp guy, and I'm sitting there sweating out when I hit, the enter button of, did I get my stuff right? But so that'll be cool. So theoretically, software and that kind of helps because, calling people on a phone, typing into Excel just needs to go away.
Right.
That's.
It is. Like we said earlier, it's one of the last markets that trade this way.
Yeah.
And by the way, it's very similar to the carbon markets, which we're actively involved in too, where this idea of trading is just very much a phone brokerage game or a chat brokerage game, and so it's just time for this market to be a little more modern.
Last question, kind of on the business, and just for the listeners out there. I told Bryan, we're going to jump in and talk about trends and all this, and we'll get to Aegis at the end. And of course, we've spent all this time, but it's been interesting. So your primary business is bilateral swaps. Tell us real quick what that is and how those things kind of look like.
Yeah, at its most basic, it's called a swap because you're swapping a variable price for a fixed price. That's kind of the simplest thing. So, if I want to lock, if I have production next year and I want to guarantee a price, then I will effectively sell my crude oil or natural gas at that price, and I enter into a contract. So if the price is higher than what I agreed to sell it for, then I owe the bank money, and if it's lower, then they owe me money. So it's effectively I guarantee the price that I'm going to get for that contract. There are other derivatives of that. So not unlike any market, you can have options, you can have puts, et cetera, and set up collars and calls. And so there's lots of different ways to hedge it, but you're effectively entering into a contract that gives you certainty around the price you're going to receive in the future.
And this is really going back into the brain because I've had a lot to drink since I left Kane.
You're doing great.
But are they done under ISDAs?
Yes.
Kind of. Okay. What's an ISDA?
Ours are. Oh gosh,
do you even know what it stands for?
No, I don't.
Anyway, but the agreement. The A is agreement. It's it's ISDA, but it's basically a standardized contract that you enter these swaps with.
Exactly. It defines how things will be settled, how things will be calculated, what sort of credit charges. So it lays out all of the underlying terms of the deal, if you will.
Good. And when you do a bilateral, does it get cleared through an exchange? It doesn't go through NYMEX. It doesn't go through ICE. And wow, I'm recalling my NFA test. To be excluded from that under Dodd-Frank is because you're actually an operator. Is that why?
Yeah, it's called a permitted transaction. To get, if you remember that term. So there's required transactions that have to be cleared. These are permitted. You have to be a commercial end user. So, you have to be hedging an actual business risk. So this is not speculators that come out and enter into these, what are called permitted transactions that don't require clearing, but we can get into a ton of detail.
So two hedge funds aren't doing bilaterals.
That's exactly. They could theoretically, if they have an ISDA set up with each other and they could enter into a bilateral transaction. That's pretty rare though, because two hedge funds entering into an ISDA would be.
Yeah, doesn't make any sense. Right. I got you. Okay. All right, let's jump into trends. So oil, I've never seen this level of backwardation, and it doesn't make any sense to me. Am I right? Am I wrong? What's sentiment out there on that?
Yeah, look, our job is to make the bear and bull case, and talk about what's the best way to protect risk. So we try not to make calls on price.
We'll make both sides of it then.
Yeah. Look, I think the bull case on crude is pretty simple. Massive underinvestment for a long time, and this has been obviously well documented and well talked about. Not as much capital going into the space, therefore production's just not coming the way we thought. Demand is continuing to increase, and I think you're going to you're at a place where we are undersupplied at this point. The bear case is also equally simple. How do we avoid a recession at this point? Yeah. I don't know, right? How longer? I paid $5.59 for gas yesterday in Texas. I just don't know how long people are going to continue to put up that, and we're going to, are we going to see demand destruction? Look, let's hope we never have COVID again. But what's the next outbreak? What if Putin pulls back and says he's sorry in Ukraine, and we go back to normal? There's a whole bunch of things that could, that could bring prices down, but I think the bull case is hard to ignore on crude right now.
So I've had a theory about backwardation because, I just don't understand how oil can be 110 and you can go out to Dees 25. By the way, it sounded like I was a trader there. Dees is just December. But anyway, Dees 25 and get a barrel, I think, for $75 or something like this. I've always been an efficient market guy. I mean, NYMEX futures doesn't mean they're right, but it is the collective intelligence, if you will, of every participant. The airlines have been in the tank, and historically they've been the buyer of the trade, particularly kind of like years 2 and 3 in the out years. And they've just been in a world of hurt till about the last 6 to 8 weeks, really. I mean, they're starting to hit 90 some odd percent of kind of pre-COVID type numbers. I think they're realizing they're going to be around as an industry now and all. But is there any chance we're just in backwardation because you had every producer who saw minus $37 oil who would be willing to hedge at some price, and the natural other side of the trade just wasn't there? Is that anything? Or
yeah, I mean, you're hitting on
you're
hitting on the right point. Who knows is somewhat the answer, but you're right. The market, the forward curve is not designed to be efficient, right? It's just what someone's willing to pay right now. It's not saying, it's not necessarily saying what the price will be, but hedging is one of those things, right? I wasn't that long ago when we were talking to customers who were saying, gosh, if crude would just get back to 40, right, we'd have a fighting chance. And now you can sell your crude, 2 years out for $85. That back to our, country clubs filled with people who sold too early. If I could lock in those kind of returns, that's not the worst bet that someone could make. So it's just all a matter of how much you're willing to live with. I mean, I hear people say they invest in oil and gas because they want exposure to commodity prices. I don't buy that. I think they want exposure to great companies that know how to drive returns on their capital, and that's what they're after. I
always say they want the optionality of the home run, and they don't want the downside.
That's the more honest way to say it, for sure. But gas is really interesting. So, but crude is harder to hedge. I won't get into call skew right now.
So real quick before we jump to natural gas, because I don't understand natural gas at all. I always get that wrong. Is it your sense that your customers on the producing side are sort of willing these days to hedge out 3 to 5 years, or are you seeing shorter duration on what they're willing to do?
Yeah, we're seeing a bit shorter duration than we've seen in
God
the
bless
past.
the optimist oil guy.
Absolutely.
It was just at minus 37, but it's going to stay at 110
It's different
forever.
this time, right?
Yeah,
and I know you've hit that before on your podcast. It's not. I mean, capital is efficient and we'll find good homes, and you're starting to see a little wearing on the renewable sector already. But gas is...
last question on oil.
Sure.
Consumers, the other side of the trade, the clients you work with there, are you getting any sort of sense of they want to lock in longer, that maybe they feel like backwardation is kind of historically weird? Or does it go back to your point of whatever their base business is and whatever they can hedge on the metal side or whatever?
Yeah,
it's just harder for them to do.
Different markets, but you're seeing people who kept thinking we'll wait this out, these high crude prices, and it is crushing diesel, RBOB, gasoline, et cetera. So you're starting to see people say or jet fuel, just back to the airlines, where people are saying, gosh, the curve being backwardated is good for us right now. Maybe it is time. These prices are historically high, but I'd rather be able to lock into something lower today and not have to wear that risk as long. So, it's just, people will tend to hedge at the wrong time a lot, because it's all
really good at that.
It's all on sentiment, and you just have to you have to really see through that right now. But it's a better time for consumers of the products to hedge, and we've got a refining issue from a crude perspective. I mean, refineries are running at 90+% right now, and so figuring out how to get more of that product to market is going to be, we'll get some seasonal, uplift coming out of the summer, but it's a tough,
and refineries historically don't do very well operationally when they run at full tilt for a long time. I mean, that's the scary thing.
Well, and you're even seeing the administration right now trying to convince people to bring shuttered refineries back online. I mean, the irony of this, just shouldn't be lost on anyone. Now, how long does it take to bring a refinery back up? I don't know, but I think that's a pretty long-term solution.
That's crazy. So natural gas. I totally missed the associated natural gas story and why natural gas went to, I'll pay you to take it away. Totally missed that during kind of the shale revolution. I also missed back, call it 2005 to 2012, the decline in natural gas, even though the strip the whole way was in, contango the whole way. What are people saying about natural gas?
Yeah, we've got a potential issue near term in natural gas, right? So this is back to really bullish in the front of the curve, and we need to be really cautious in the back. We're way undersupplied right now. We're going into kind of peak season with 350 BCF under our historical average. Like that's a huge number. And so if we come out and we also have a cold winter, colder than normal. Now that's not necessarily the base case, but if we do, we're pretty short. So I think the near term outlook for natural gas pretty strong. However, and this is what we have to spend on, our customers need to be thinking 2 and 3 years out. We've kind of seen the end of LNG for a couple of years. I mean, that has been nothing but straight up in terms of, the demand that's driven for natural gas. We don't have any more projects coming online for 2 years. So we've got
when you say project, you mean export capability?
Capacity to create it and send it out. And so that demand source is going away. And I think the sentiment out there is production is going to come back. I mean, these prices are going to bring production back. It's been slower than anybody had thought at this point, but I think we've got to be cognizant that production can come back. And, so someone starts to say, gosh, as we look at hedging options in the out years, we've got there's a point in the market right now we've never really seen before where there's a lot of call skew. Okay. So what that means is if I can swap in at $5, then I can get a floor at 4 and upside at 10.
Right.
Okay, for instance. So I've got a lot more upside for the same dollar. And so collar structures, if you're an upstream, natural gas producer, not hedging your out years with collars right now, we should probably talk, because the market's just giving you a great opportunity to participate in the upside and limit your downside. It's pretty unique.
So I heard a theory on this, and I need to give credit to it. It's Brad Olson. I don't know if you've ever met Brad, heard about Brad. Brad's kind of mid-30s, long-only hedge fund called Recurrent. And Brad's he's a rice guy, so I'll pimp my college rice. He's really smart, all that. But Brad's dug into the data, and actually what Brad has found is the number of rigs running. We all think it's the higher price, the more rigs we have running, right? He actually has found a tighter correlation between trading multiples of public companies and the number of rigs running. Meaning if I'm trading at 12 times EBITDA, I'm putting as many freaking rigs out there. I don't care if the price is $40, $30. I'm getting paid 12 times for generating this EBITDA. I'm going to go do it. At 3 times where we're trading today, and some of the natural gas guys are even lower than that, it's like, I don't have the incentive to go run all those rigs and mess with all that sort of stuff. And so guess what? I'm just going to send the money back to my shareholders. And so, when he told me that, I was like, hey, you're crazy, you're stupid. But the more you think about it, show me your incentives, I'll show you your actions. And so, because I remember just looking at the Delaware Basin, and if you got 2 West out there in Culberson County, it became really gassy. And at $1.75, you're like, man, we can't do that. Doesn't make any sense. But today at $9, you could get, and I said Culberson County, that's Permian Basin. I was county dyslexic, which was very much a hazard for being a oil and gas guy. But you get out west in the Delaware Basin, you can hit 30 million a day wells of natural gas. And so there's tons of it to go drill, the Haynesville, et cetera.
Right. Well, and that's, I just believe over time you are going to see the capital come back to the space.
Yeah.
I'm not saying that's going to be next year or the year after, but the long-term trends have to be that this is here for longer than any of us are going to be alive, that we're going to be, completely dependent on hydrocarbons and,
this time it's different.
I
like it.
Yeah. So anyway, we're not trying to, predict price. We just want to paint the upside. And, when we talk about when should you be hedging, to us, it needs to start with when are you making money?
Yeah.
And, if you can guarantee that you're going to make money and you can continue to fund your drilling programs or your dividends or your debt repayment or whatever those things may be, it's hard to get worried about, small price movements beyond that.
So give us one other trend that maybe folks in the audience haven't thought about, haven't heard about, something out there that you can kind of let us in on.
I don't know that people haven't heard about this. I actually find the work that oil and gas producers are doing, and by the way, there's certain things we don't say. We don't say energy transition. I actually try not to say energy anymore to describe this space because I just think oil and gas is so much more important than just energy. But
you get my podcast canceled, but go ahead.
Well, we can talk a little bit about that. But I actually think that what's been really fun for us to see, because we work with so many producers and see so much of the oil and gas industry, is what people are doing to reduce emissions and become much better stewards of the environment. And I think for all the talk of carbon offsets and what does voluntary mean and greenwashing and those sorts of things, I've been just really proud of the industry and watch what they're doing in terms of monitoring, making real adjustments to drive emissions down, and then even taking steps to go beyond that and try to get their footprint closer to, to net zero. And we can, that means a lot of different things to a lot of different people. And even to a point where we're now seeing some producers who are able to turn their operations into credits, carbon capture, utilization, sequestration, CCUS for enhanced oil recovery, putting CO2 down hole to do some, sort of last mile recovery of oil is actually carbon negative. And you can generate credits as a result of that, which is going to enable more investment back into it. It's just a really fascinating trend to watch on as people are getting smarter about how they're managing their operations and being better stewards of the environment. It's creating a lot of new opportunities to do.
Well, what I tell people is you can sit there and say it's big bad government making me do this, or it's all these wacky environmentalists making us do this. It's not. I mean, the reason we have all this pressure from all these institutions is because Joe Blow American really cares about it. And we can have a choice. We can go be obnoxious assholes to those people and tell them they're stupid, in which case we'll probably be legislated out of business, or we can go educate and we can be a partner with those folks because there is a lot of ignorance there. And ignorance does not mean stupid. It just means uneducated. And so, I mean, the pension fund that says, I care about this, I want to hear about emissions, is saying that because they either report to a government official that was elected by the people, or they are reporting, they have restrictions and guidelines from their members. Teachers, police officers, firemen are saying that. And so, and it's getting to the point in the future where literally if you want to be in oil and gas, if you want to be able to sell a property, if you want to be able to access insurance, financing, whatever the case may be, you're going to have to be cognizant of this, and we need to embrace that. So
perfectly said.
Yeah.
And I think,
and it's the right thing to do.
Absolutely. And I've heard you say many times that the industry needs to rebuild trust. And I kind of go the next step and say, get on their front foot about telling these stories a little bit differently. I just think what's happening, again, what we just talked about, monitoring, changing operations, is real. And people are just much better stewards. They need to be able to tell that story. back to why I talk about, about oil and gas versus energy. All the talk of, electric vehicles, let's just use that as an example, as limiting fossil fuel. Well, okay, let's just talk about the tires, on the car. Let's talk about the asphalt roads that you're on. Let's talk about the plastic that's inside. Let's talk about the crude oil that was burned, mining the lithium, it's broader than energy. And I just think it's the one commodity that everybody not everybody on the planet, unfortunately, we'll talk about that in a second, but that almost every American, the minute they pick up their cell phone, has touched that commodity today. The minute they get in the car, they've touched that commodity today. There's not many commodities that people do that with. And I just think we need to talk about the role oil and gas plays in a different way. That's, yes, energy is important and will be, again, for the foreseeable future. And it does a lot. There's just a lot more to it.
Yeah, there's no question that, it does a lot of good things. We need to highlight that message. One of the things we did the Zero streaming event last week, and a question I asked a couple of times on the panels I was involved in is, okay, we're doing all this. How do we get credit for that? And I think that's all of us in the industry need to be thinking through that is, hey, we just did a great job with emissions on this field or that field. How do we get credit for that, telling our story? And I've got to give credit to Addison Holmes with Pickering Energy Partners. She actually says the SEC guidelines that are coming forward where you're going to have to report emissions is going to be good for oil and gas because it's going to level the playing field. We're going to understand what Amazon's carbon footprint looks like and the other technology folks out there. So
right. Well, and what's interesting to me, this bothers me a bit that if I'm S&G, I'm really frustrated because ESG is now fully focused on climate and climate only. And I think that's one thing we've got to start to do and which is important, by the way.
Yeah.
We need to be better, but there's also the S, in it, the social piece of this, the energy poverty around the world is a much bigger issue than most social issues we're talking about today. Access to affordable housing, much bigger, social issue today. Inflation and the impact on purchasing power for the middle class, much bigger social issue today. That's a big thing that we've got to factor into these discussions. And then, the governance is a fascinating one as, someone who's a, chair of a comp committee of a public company. I view I really know what governance means, right? I've actually held accountable to that. I think just simple governance on how long we're going to allow unprofitable ventures to continue to chew up capital in the name of, social good is just something we're going to have to reconcile over time. I believe there should be investment. I believe renewables are needed. I believe they're additive to, serving what are going to need to be, future, energy needs. But, we've got to allow some of these things to run on their own and make a business case so that, to your point, we can level the playing field across all of this. So,
and we ignore CO2 rising and temperature rising at our own peril. My turn to get my podcast canceled instead of you. Is the science ironclad that we know exactly what's going to happen in 75 or 100 years, how quickly this is going to happen? I don't think it's that settled, but you'd hate to look up 100 years from now and go, oops.
Yeah, I totally agree. And to me, that's why I just wish everyone used the word and.
We need to be thoughtful about it, and we need to spend 100 on the problem instead of 500, because that other extra 400 could do a lot of societal good.
Exactly right. We just don't use the word and enough, right? We need to do this and this, not this or this. Yeah. And look, we'll get there. You start to see some of the sentiment, shifting a bit already, I think, and we'll find our place. Everybody's heart's in the right place. We know these are things we need to get after. We'll land. We'll figure it out.
So speaking of heart, real quick before we go, you got to tell me about 17. So I'm going to hold this up so that, where's my camera? So tell me about 17, because We are not above this or below this or whatever, above this at the Chuck Yates Needs a Job. We take bribes, and you brought a bribe, which was very cool of you. Tell me about 17.
Yeah. We actually, we call it 1-7 just because that's baseball speak. But my best friend and I were out in Napa, and we had a lot of interesting things happen in 2017. We happened to both be the same number in college. We were both 17. The 2017s were in barrel at the time, and we just got to talk and said we need to have our own label. And so in baseball, you would say 1-7 generally if you're talking about someone's number and referring to them. And so we decided to do our own label. And I know you're a bit of a wine drinker, so I wanted to bring you in on it. So it's just, we
1-7.
We don't do anything to sell. We do things to share. So,
that's very cool and much appreciated. And I'll just go ahead and get on the soapbox here. When you hang out at Digital Wildcatters, there's a bunch of 30-year-olds. There is not a a corkscrew in this whole place. Yeah.
I certainly could have brought one of those.
Yeah, well, I should have brought one too. But anyway, well, Bryan, appreciate you coming in. Good stuff. How do folks reach you?
Yeah, we're Aegis, AEGIS-hedging.com is our website. And then everybody is first initial, last name. So I'm B Sansbury at Aegis-hedging.com. Love to hear from.
And so folks that want to hedge, buy, sell, you're there to help them out.
Yeah, we're going to do everything from helping people just understand markets, and that's broadly across oil and gas, metals, also including carbon offsets and other environmental offsets, the compliance pieces. We're going to help them design hedging strategies. We'll help take those transactions to market if they like and help them manage them ongoing.
Cool. Thanks again for coming in.
You bet. Thanks for having me.